All right. Hey, everybody. Glad to have you all here to join us today for our webinar on investments. And this is the second installment. We did investments part one a few weeks back, and it's part of our ongoing series, which is made up of two things. Number one is what we call Bear Facts Friday. That's a brief video that comes out every week that gives you some high level information on the news that you should unpack for the week, as well as some perspective and some wisdom along with it. And then in addition to that, we have our webinar series. This is part of our webinar series today. And all of that information can be found on our website. If you go to bearwealth.com, and then at the top of the page, you'll see the Bear Facts. And that's where all of this is going to be available to you for you to review it and share it with those who you care about as well. But what we're talking about, not only today, but as part of our broader webinar series, is something that we call your financial success matrix. And what that looks like is it's actually made up of three different parts. And we'll start at the bottom. Uh, Anything that's good and that's sound is going to have a strong foundation to it. And in financial planning, that is also so true and so important. So we start with our financial planning foundations. From there, we move up into investments, understanding what they are, how they can work, and what yours could or should look like. And then lastly, we move to the top of the pyramid, which is advanced planning. These are more specific or detailed oftentimes. Sometimes it can be a little bit more sophisticated planning strategies, just depending on what your particular scenario and situation is. So that's where we are with our ongoing series. But to start out with today, I'm going to hand it off to Kenny, and let's do a quick recap from our investments part one from a few weeks ago.
Yeah, so investments, the part one, what we talked about was first the different types of investments. It may sound like it may or may not, but for most people, you probably might think you know what those are, but they're vast, and it can range from artwork to a private equity investment to a real estate investment trust to basically anything that you're buying today that you hope will be worth more money in the future. And with each types of those investments, there's a different type of risk. And with anything that you buy today and hope to be worth more in the future, there is some risk associated with it. And the more you hope that thing or that investment will be worth down the road, the more risk that is going to be associated with that investment. And so you've got the public markets, right, where you're buying stocks like Coke or Home Depot or whatever. You buy today, you sell tomorrow. There's total liquidity, but there's a lot of volatility. So lots of up and down with those, as we've experienced, and I think all of us here know all too well. And then there's also private equity, right? So private equity is you buy a company, and that company may have no liquidity. It's held in the private markets. The only liquidity is when it is either sold to someone else, or there's money, cash flow put out back from the business. Then you can get into venture capital, where you're talking about startup companies. And with those, you have higher potential reward, but you have more risk. You have risk from the standpoint of the investment might be worth less down the road, but you also have risk in that you can't get the money if you needed it when you needed it because there isn't liquidity. Second, stocks, you own part of the company, right? You have the right to the future cash flows of that company. As those cash flows grow, or as that the future value becomes you think will increase, then the value of your investment will increase. You own a part of the company. If you buy one share in Coke, you are an owner in Coca-Cola. Bonds are you're loaning money to a company. So I'm going to loan money to Coca-Cola. I have no right to any future cash flow. Coca-Cola is obligated to pay me whatever interest rate it is. And then at the end of the period, they are obligated to give me my money back. So I'm loaning them money. I already talked about the risk return trade-off. being compensated for the amount of risk, right? Just goes back to the point of, if I want my money to be worth exponentially more down the road, there's probably exponentially more risk. There's no free lunch in investing. And then I think we talked last time too about markets are forward looking, right? They are pricing in the future. So the current situation, at least as I look at it today, is our economy is in total shambles, right? We have a huge unemployment. We've had massive GDP decline, I think the greatest ever, quarter over quarter. But that's not what the market price is in. The market price is in the future. And as news about a vaccine comes out, as news about potential treatments, as news about the virus diminishing as the weather gets warmer, whatever it may be, the market's pricing in that. And that's why we've seen this big rebound since the bottom.
Yeah, that's a really great recap. Covered a lot of good points there when we talk about what is investing. And those concepts are some of the basic but core concepts that any investor should be familiar with. So hopefully that was a good refresher for you, especially for everyone who joined us last time. And then the next thing that we had looked at in part one was, okay, well, taking that information that Kenny just reviewed for us, well, what does it take to get that return? Some people say, oh, I just need X% return. I want 4% or 6% or 10%, whatever it may be. Let's look at what it takes. And so if we just look at the 50-year period ending in 2018, we'll look at 3 different data points. The first one is inflation. Inflation over this time period was 4%, which is actually a little bit higher than our longer term inflation, about 2.5%. But this is what it was. And so what that means is that if you had started with $1 in 1969, it would be worth about $7 in 2018. So $1 of purchasing power, now you would need $7 for that same purchasing power 50 years later. And so if we move up the risk return spectrum that we just talked about, one logical next thing would be, well, what if I had my money in T-bills, which is essentially a cash or cash replacement? Those did slightly better than inflation over this longer time period. And nothing on this chart is quite to scale, but it is pretty accurate representation here. If we follow the black line, that shows what about a 4.7% return looks like. But there it ends, and $1 became $10. But one thing that we have to note now is that you did have to accept a little bit of risk, a little bit of ups and downs along the way, which is represented by that multicolored line there over time. So not too much volatility, but certainly some, to get that better return. And then if we keep climbing up the ladder and look at the S&P 500 and see what that did, it returned 9.8% over this 50-year period. And so what that means is $1 became $107. That's a drastically larger amount of money. And the return was greater. But what did it take to get that 9.8% return during that time period? Again, not quite the scale, but pretty accurate of the ups and downs that you would have had to stomach. They're much greater, they're much sharper, they can be much more severe and sometimes painful. And so the question that every investor needs to ask themselves is, well, what does it take to get what I am looking for in my investment journey? And what is my particular situation and what am I trying to accomplish? What we try to work with clients on is understanding that finding this balance between stocks and bonds, but also potentially other assets that you have, other asset classes, to make sure that everything is really working together.
Yeah, I think this is a great illustration of this. And it's so easy to get lost in the ups and downs and be like, oh, well, my S&P returns 9.8%. That's where I want to be. But each one of those little down lines in the presentation here, each one of those, ups and downs, that could be 5 years, right? That could be 10 years. So, on a piece of paper, a graph looking back to 1969, oh, that's not a big deal. We'll just, we'll get 9.8%. But in reality, that's a lot easier said than done. And, look.
But it could be 5 years and it could be 50% too, right? Like thinking back to 2008, 2009. I mean, your equities, your S&P represented here would have been down more than 50%. So that's, again, easy to talk about either in hindsight or just on a screen. But then when you're living through it, it adds a whole different dimension to it.
Yes. And look, I think of it too, Mark, like this. It's like, it takes the discipline. I can talk about like working out as an example and what it takes to be, have a perfect physique. It's very easy to talk about. We know what it takes to do it. It's just a matter of doing it consistently and having the discipline to do that. And that's where, like, I feel as advisors, we help our clients do that, right? We can help them stay disciplined. It's like having it's like the personal trainer, right? It's a lot easier to do if you got somebody knocking on your door telling you at 7 a.m. it's time to get up than if you just get up on your own, especially, if you're paying that person as well. Make sure you're utilizing
the accountability factor, for sure.
Yeah.
Let's move into what we got on deck for today's topics. And that includes, number one, talking about this idea of the market and what that means, and then some ideas surrounding how potentially you should be investing. So to start out with, let's look at what the market is or what it could mean. And that really plays into what are some different indexes that exist out there. And the first one that we're going to look at is the Dow Jones Industrial Average, otherwise known as just the Dow. When people refer to the market, whether it's on CNBC or Fox Business or the headlines, or you're talking to your neighbor, something like that, when people say the market, a lot of times what they're referring to is the Dow. You hear the market moved 500 points today or something like that. This could be it. So really what the Dow is, though, is it's only 30 stocks that are of publicly traded companies, 30 blue chip, large cap stocks. And historically, back when the Dow was first started, it was the original style industrial type companies, I guess I would say, a lot of railroads and things like that. Today, though, it includes a variety of companies that we've all come to know and probably experience at some point or another. For example, Apple is part of the Dow, as is Exxon and Chevron, Procter and Gamble and Walgreens and Caterpillar. All these types of companies make up the Dow. And so they can be a really good indicator of the broader economy and what else is going on in the stock market. But it is important to remember that it's just 30 companies. And as we'll talk about here in just a second, just in the United States, there's nearly 3,000 publicly traded companies. So these represent 1%, really. And how the Dow is calculated is it's called a price-weighted index. And what that means is they take the price of each of those underlying stocks and apply a divisor to it. So it's not quite as simple as just dividing it by 30 stocks. There's a formula that goes into it, but with that price-weighted index, just know that the price of each of those securities is what drives the index itself.
Yeah. And then the S&P 500, simple 500 largest companies in the United States by market cap. So market cap means if I'm to buy every share of a company, then how much would that cost me? Amazon, I believe, is the largest. It was $1 trillion. Apple is close as to where the smallest company in the S&P 500 is still several $billion, but it is the 500 largest companies in the United States. And the price, it's a more accurate reflection of the market itself, right? So the Dow is just 30 stocks. The way it's configured is totally bizarre in essence. Like if the way the S&P 500 is, at least now we're moving to 500 stocks, and the company that has the biggest portion of it has the most effect on the index. So it makes more sense. If you were to actually invest in the S&P 500, how the index looks, and Apple has the best day, it has a much higher weighting towards your performance that particular day than if the smallest company in that index does, versus where the Dow is, it's not really that way. So now you start to move on looking at more broad market index. Most people don't follow it, though, in the terms of day in, day out. Most people, when you say what the market did, they're talking about the Dow. It's up, down 20,000, 30,000, whatever, some arbitrary number that somehow people think means something really, but In actuality, it doesn't, but that's what most people are talking about. Now we've got the 2,000 smallest companies in the United States that are traded on the major exchanges. And just so the smallest companies are still worth hundreds of millions, right? If you are in the Russell 2000, you still have a market cap weighting well within over 100 million or 200 million dollars. Oftentimes, most of those companies are still in the billions. So they're small companies relative to Amazon, but they're giant companies relative to the mom and pop store down the road, or even a company that's a big business that you may know from a friend of yours that started, or you may be running one of those yourself, still tiny compared to any company that's in the Russell 2000. But that's now 2,000 smaller companies. The question to ask yourself is, well, how do I invest, right? Are the 500 biggest better to invest because they're the biggest? Do you have better return on your money by investing in those 500? Or do you have better investing in the 2,000 smallest? I can say historically, over as far back as you can get data, you have higher returns investing in the 2,000 smallest than in the 500 biggest. But as we move on to the next index, now we've got it all, right? The Russell 3000 is every company in the United States. There's about 2,900 or some odd right now. And that is the true market of at least the United States market, right? So we look at that, that's covering the market. It's the same calculation as the S&P 500, gives you a better idea of what the return of the total market is on 1 day, 1 month, 1 year. And, it's just pretty much it. Mark, do you have anything to add to that? I was going to say,
Yeah, I mean, I think I agree that yeah, I agree. If we're sitting back trying to be as objective as possible, it'd be kind of hard to argue against looking at the Russell 3000 if we truly want to know, well, what is the U.S. market doing? But it is also clear to see how each of these indexes have a place and how they have an importance. Like, for example, the S&P 500, although it's only 500 out of about 3,000 publicly traded companies, the sheer size of those companies makes up about 85% of the entire U.S. market. So that being said,
was the point that I was going to say.
There you go. I took it from you. I had to get in before you did. I knew you were going to say that. But so that gives you a little bit of perspective and frame of reference. I think they're all unique and equally important in their own right. And our main takeaway, what Kenny and I want you to know, is just to understand the nuances and the differences between them, and recognize that it's not just a one size fits all. Quickly, the NASDAQ composite, that's a little bit different in that it's 2,500, not only stocks, but also REITs and American Depository Receipts and other things like that. And really, this is dominated by tech nowadays. And I think,
yeah, and so the NASDAQ is heavily dominated by tech. It's done great lately because you got companies like Facebook, Google, technology companies that make up the vast majority and account for a huge percentage of the return or not. But the NASDAQ itself has only gotten back to where it was in 1999. Really not that, it took it 20 some odd years to get to where it was from its previous high, because it grew so fast during the tech bubble of the late 90s, crashed so far, and has since come so far back up because of what's happened with the big technology companies that have done so well as of late.
Yeah, and good point with the next graph that we've got on the right side of the slide here is that, probably not surprisingly, or hopefully not, each of these indexes can and should have different performance. And the takeaway from this little chart here is not that you should be investing in one, or the companies in one versus another, but really that there can be variance. And hopefully, as we've just described to you, now you understand why. The S&P 500 has done pretty well, dominated by these large cap companies, versus the Russell 2000 with the 2,000 smallest hasn't done as well. And then in addition to that, the NASDAQ has far exceeded anything else as of late, with COVID and everything else going on, because a lot of these tech firms are really thriving as people are working from home. There's more digital type services and the like going on. Hopefully, it's not surprising to see that as of late. But yeah, I mean, any one of these indexes, any one of these ideas of the market, they can be right. They're not wrong, but they can mean different things.
And just the other quick point to take away is, look, past performance is not indicative of future results. Otherwise, it'd be very easy, right? Looking at this chart, I'd be investing all my money in the NASDAQ. And I wouldn't want to invest in the Russell 2000. But if I look historically, which of these indexes has the best return from a compound percentage, as far if you can go as far back, it's the Russell 2000. I think the statistic is $1 invested in the S&P 500 in 1929 is worth about $5,000 today. $1 that if you could have invested in the Russell 2000 in 1929 would be worth over $20,000 today. So you know what's happened doesn't tell you about what's going to happen.
That's right, because as you told us earlier, market's forward looking. And then you also gave our legal disclaimer for today.
Yes.
Now, this is not specific investment advice. It's just information for you all out there. This chart I think is pretty neat because piggybacking off of the last few slides, we've just looked at the U.S. markets and different indexes within it so far. But it's important to know and try to appreciate the fact that the United States market makes up just more than half of the global investment opportunities when we consider all other countries in international developed markets as well as emerging markets. And so we'll get more into this on our next investments part 3 webinar. But just knowing that the United States it's a very important factor, especially because we live here, but it's not the only thing that's available to you.
Yeah, I think to put this in perspective, right? So you've got 46% of the rest of the world that you can invest in. Is there a reason you shouldn't? Well, historically speaking, not necessarily. I mean, the returns of foreign markets aren't worse than the U.S. markets, and they add a diversification effect. So if you sprinkle in international investing, you do not lower your expected return, but you do lower the overall risk. And that's one point to learn from this. And the other is to put things in perspective is like when people talk about the example that sticks out in my mind for whatever reason is when people were so concerned about Greece roughly 10 years ago or something like that. It makes up 1% of the global market capitalization. If that, it was roughly less than that. It was roughly the same size as Microsoft, the Greek markets in total. So just to keep things kind of in perspective when everybody was freaking out about what that could mean, in the grand scheme of things, it's a tiny fraction of the world economy.
Yeah, that's interesting. All right, well, let's switch gears a little bit here to part 2 of what we wanted to cover today, which is how you should think about investing or what different options might exist within that. And so I'll start out with this one here. Think of this conventional approach as each of the dots on this slide represent an individual company that you can buy the stock for. And with this thought process, what you're going to be doing is identifying the winners or the ones that you think will outperform the others. Those are in green, and you're going to buy those. And conversely, the ones in red are the ones that you think will underperform or that they're overvalued today, and you're going to sell those. So in this way, you're attempting to outguess the market by saying, I know who's going to win and I know who's going to lose, and I'm going to put together with my knowledge base the winning portfolio, and I'll be able to perform better than the other millions of investors who are out there. And there's a lot of folks who subscribe to this thought, but we would submit to you that it can be a losing prophecy in the sense that not only do you have higher turnover and potentially costs that you've got to deal with, but you've now also got to deal with the emotional and psychological factor of getting this right, because you've got to get it right not only when you buy, but also when you sell in order to have a chance at outperforming just the broader market and the broader investment knowledge base from across the globe. And so to show you this or to illustrate it, this is looking at that conventional approach and mutual funds for the last 20 years, from 1999 to 2018. And as you can see, both on the equity or stock side and the fixed income side or bonds, this approach of trying to outguess the market really didn't prove to be that successful. And the same holds true for longer periods of time as well. What it shows is that you've got a really great likelihood of your fund not even surviving for the time period, going belly up, going out of business before the time period was over. But if by some chance you did survive, your odds of being successful in terms of outperforming the broader market are incredibly low. It's not to say that it doesn't happen. It's just to say that there's nothing that's out there that leads us to believe that there's any reliable way to consistently do it. Nobody's got that crystal ball, right?
Yeah. And I mean, Mark said it exactly how it should be said. So I'm going to say it, and I might even be a little louder. So maybe it's heard, because it is such an important point. And that these people, first off, these are experts, right? This isn't you're competing against someone's, grandma who's never traded a stock, or whoever it may be. No offense to any grandmas out there. But
maybe somebody on Robinhood. How about that?
Correct. All right, there you go. Someone on Robinhood. These are professionals, right? This is the success of the best of the best, right? These people have, in some cases, they have PhDs in economics. They've been to the best schools. They're managing hundreds of billions of dollars, and some billions, sometimes hundreds of billions, no telling. And this is their track record. So just looking at that's thinking, do I have the confidence that I'm better than that? And that's just if you're honest with yourself, the truth is, well, no. I mean, that's just not realistic. It's possible, right? I mean, nothing's impossible, but the likelihood of you being able to have some systematic way that you're going to be better than just being the market itself is just not realistic. It exudes overconfidence. I understand why everybody thinks that this is what you should do. Not everybody, but why a lot of people think that that's how it should be done. It's easy to tell you what the good companies are and what the bad companies are. I can easily, just buy the good ones. I don't need to buy the bad ones. It just doesn't work like that in reality, because the truth is everything that is known about, quote, the good company and the bad company is priced into it already. You don't have some secret information that the world doesn't know. And so the company that, quote, is the good one has already been bid up. That information reflects in the price immediately. There is no delay. So to think that you're going to get that information in advance is just not, it's not realistic, and it doesn't happen. And that's why holding a basket of securities, you're going to be better off. Now, there are, and this kind of leads into the part 3, but there are baskets of securities that do better than other baskets. And that's where we weigh towards those baskets. Now, they don't always do better every day, every month, every year, but given enough time, they do mathematically give you better performance. And that's where you should expect to outperform in the long run, because you don't want to just be the market and be average, although for a lot of people over time, that's still pretty good. You want to be better. And then how do you do that in a way that is academic versus gut or proven, mathematically proven? And that's where our philosophy really comes in. But this, looking at how many winners there were from the professional mutual fund managers, it's about the same as you would expect from a blind luck, right? Some people would be lucky. So given enough time, eventually, there will be some who just outperform by sheer happenstance. And so the problem is you can't determine who was just lucky and who actually was skillful. And that's why buying the basket puts you in a mathematically a better position down the road.
Yeah, and then not only that, but as we mentioned a few minutes ago, there's 3,000 publicly traded companies just in the U.S. and across the globe. There's about 12,000. So how could you potentially go about, doing the research, finding out all the information, making the right decisions at the right time with not even each of those companies? That would be impossible, but even a fraction of those companies, it becomes very cumbersome. And even if you were to pick, I'll cherry pick two right here. Even if you were to have picked Apple 5 years ago, you'd probably be pretty happy with how things have turned out and how they're looking as of right now. But go back and look at, for example, what Domino's has done over the last 5 years and compare it to Apple. That's something you may be aware of, maybe not, but it's just a good realization that even though we might know and use and experience and love certain companies, it doesn't mean that they're the best performing investments over time.
Right. That's where that you get to the market being forward looking and it's priced in. You know that. We know today Apple is a phenomenal company. Amazon is a phenomenal company. So all of those future cash flows and the value of that company, that is priced in today as to where, it might be less certain, at least it was less certain about a Domino's, right? Because what they went through a whole reorganization and such. At that time, it probably didn't look quite as good as a company like Apple, but then the resulting performance was that much greater. Going back to, it goes, the example I was taught, the example I was taught growing up in this industry was if, I could come down with a crystal ball and I would tell you that cell phone technology and cell phones were going to be the future. It was guaranteed, right? Everybody is going to have a phone in their pocket. And then I could tell you which company would probably be one of the leaders in the producing and selling the phones. That company would be Motorola. I'd say you can invest in Motorola, let's say it's 1984, something like that. And I'll give you the choice to invest in that. Or the other company I'll give you the choice to invest in is the company that makes Spam, Hormel Foods. There would not be anyone, if you're being honest with yourself, that would say, I would rather invest in Spam. I love the future of the Spam market. But everybody would have taken advantage and thought, absolutely, I want to be all over Motorola. But that was known. So the future performance wasn't indicative of that. You would have had vast outperformance by investing in Hormel Foods in this example versus Motorola. And that's just an example. Even though it's priced in and you can't necessarily have an investment advantage from that.
Yeah. All good examples. I'm sure we could pluck some other good ones out as well. Maybe we will for part 3. We'll keep people on their toes there. But Kenny really highlighted this basket approach. And when we think about the original one, the outguessing the market, buying and selling certain ones, an alternative approach is what's called the indexing. So you put, in this case, think of all the green dots as the S&P 500, just as an example. Those represent the 500 companies in the index, and all the gray dots are the rest of the publicly traded companies that would be available to you. But you've come up with a framework of rules and parameters about what's going to be included and what's going to be excluded. And with this, it just becomes much more efficient and much more practical for investors to really receive the benefits of diversification. That's one of the primary benefits of doing an approach like this. And how you can actually go about implementing that oftentimes is through something called a mutual fund or an ETF. There's a lot of similarities, but also some differences between the two when it comes to their tax efficiencies and things like that. But think of both mutual funds and ETFs as a way to create these baskets of different securities. And those can be any different thing. It could be an S&P 500 fund, or it could be a fund focused solely on space exploration or gold mining or anything else that you could dream of, really. But these baskets allow you to achieve that diversification that we're seeking in a much more efficient manner. And anything that you would add to that?
Well, I mean, it's just, if we can come to the terms that we agree, right? The best way to invest, I mean, whether you agree or not, the facts back up what we showed, right? That you're not going to outperform by trying to pick the good ones and avoid the bad ones. At least historically, there's no proof that you would be able to do that. We've got to buy a lot of different securities. How can we do that in the most cost-effective way? And you have to put it in some sort of wrapper. It's not practical for us to buy the Russell 2000 and buy all 2,000 companies. The tax implications, the trade costs, the ability to move in and out from one to the other, it doesn't make sense. We can't do that here, and we have the technology and such to trade on a massive scale. Certainly you couldn't do that at home. So you've got to outsource that to a company that is going to do that for you. And that's where we help. What is the best way? What is the most effective way? And you either use that through a mutual fund or ETF, which is just what you had just said.
Yeah. Well, good. Well, I think that's a great, really stopping point for today and introducing what we'll get into in part 3 of investments, which will take a deeper dive into asset allocation. How should you think about divvying up your money, so to speak, between the different asset classes that are available, as well as looking a little bit more under the hood into the global opportunities that exist outside of the United States and why that might make sense. Ultimately, what we're going to be getting at is showing you, an alternative approach to that conventional approach that we started with, because it can be full of mental errors and ultimately just emotion. And as humans, we're just not hardwired to be successful investors. It's just a fact of life. There's a lot of factors that really weigh on us that cause us to make bad decisions when it comes to investing. And so instead of relying on these types of things, ultimately what we aim to do is come up with a systematic approach that combines research and the design of your portfolio and how you go about implementing all of that to help you avoid faulty reasoning and ultimately, hopefully, have a better investment journey along the way. So that's what we will get into next time. And just as a reminder, we've got all of our content that we're putting out with Bearfax Friday and with our webinar series up on our website at the Bearfax. So please check that out and let us know how we're doing and if there's anything else that you might want to see from us and that we can incorporate in our future discussions. Kenny, any parting words for you?
No, just hope that everybody has a great, safe week, and hope you're tuning in. Feel free to share these if anybody has any questions about the market or they're thinking about what they should do. I mean, I think these webinars are a pretty good lesson. Send them to our page and have them check it out. So that's it.
All right. We'll see you next time. Thanks.